In this video, we're going to cover off 7 key steps in constructing your retirement income portfolio. A retirement portfolio looks far different than a pre-retirement portfolio. Before retirement, you're accumulating assets. When you transition into retirement, you are deaccumulating. And that deaccumulation strategy needs to be very practical and very dialed in and tied to your retirement income plan. Ideally, this planning should start 3 years in advance of your retirement date. However, it's never too late to apply these 7 steps to your own portfolio construction. As you try to balance off competing priorities, getting enough return so that you can cope with tax and inflation increases over the years and maintain purchasing power, to make sure that you're tax effectively investing, to make sure that you've got money at the ready to deal with income and liquidity needs, and making sure your portfolio does not experience excessive volatility in your retirement years, which could really derail your retirement income plan. So let's take a look at the 7 key steps. Before I go over the 7 key steps to take in building the portfolio, I think it's important just to provide some background context. So these steps emerge out of our 30 plus years of working with client families to actually plan for retirement, go through a transition to retirement, and to be successfully retired. And we've had the experience over 3 decades of going through a number of market cycles, investment market cycles, and we know what works. So I'm going to share some things with you that may not be rocket science, but if these steps are applied properly, you're not going to worry about unretiring or outliving your capital. And so these steps are born out of just ongoing work with real life families as they plan out their retirement and then enjoy their retirement years. And each of these points are really critical. They may seem simple, but if you miss application to any of these steps in your plan, it has the potential to derail some of the planning that you're doing. So it's a really important area. So we'll quickly go through each of these steps, and then I'll unpack some of these steps in much more detail. So what kind of investor are you? Are you a money under the mattress investor? Are you a low risk temperament? Are you a higher risk temperament? And more adventurous in your approach to life generally and to investing? That's an important area to take a look at. Because what happens is sometimes we have to encourage people to get out of their comfort zone in order to achieve their financial objectives. And for other people, we have to encourage them to pull back their natural inclination to take more risk because that's their basic temperament. So it's trying to find that right optimized mix between investment temperament and portfolio structure. Do you have a retirement plan? So we use Snap Forecasts. You've seen that in many of our videos. We're going to take a look in this video at 2 specific scenarios where the client has an investment temperament that's conservative. We'll take a look at the outcome from that SNAP projection, and then one that's more aggressive and how the 2 compare. The forecast helps us with drawdown strategy, very specifically tax strategy, and which bucket to take from and in what order. Timeline investing or investment timeline is a critical piece. This is the connection between your retirement income plan and the actual construction of your portfolio. And actually, our retired clients have 3 different portfolios based on 3 different timelines and then an aggregate overall investment mix. This is a really practical part of the video to define how to connect a plan to your portfolio. We do talk a little bit about managing your balance sheet because it's not just about managing your retirement portfolio. It can be about managing your balance sheet as you transition into retirement. And that's basically your net worth, your mix of financial assets, real estate assets, and what you need to be thinking about before you retire. And then ultimately, the timeline and the SNAP projections will help us define the asset mix that's recommended, ultimately the security mix. And then there's ongoing maintenance, which is around profit taking, fine-tuning the mix, updating the projections over time. So those are some of the key areas. Now, let's take a look at what kind of investor are you. So are you a money under the mattress investor or a risk taker? That's the first thing to talk about. The value of the forecasting is it sometimes allows you to move your thinking about risk a little bit along a risk continuum. So in other words, if you're very conservative, that's the approach that you want to take, but you run the analysis and you find that you're running shortfalls or it's not doable for you, well, then you have to change your goals or income cash flow requirements, that kind of thing, or change your approach to investing. That might be 2 of the areas you need to take a look at. And how retirement affects the psychology of investing is critical as well. So people are often really surprised at how hard it was for them to make the transition from being an accumulator of financial assets to a deaccumulator. When you accumulate financial assets, there is a sense of pride about the effort and work and sacrifice that you've made to build a portfolio, and you're proud of it, rightly so. So when you go into a transition, when you're beginning to use the money for retirement, that's very destabilizing psychologically. And what helps you to get over that is that you've done your homework and that financially you've got a solid plan that allows you the freedom to deaccumulate without worrying about your income security over time. So it's a really critical part of the overall planning. So ultimately, it's about balancing risk and return in terms of the overall plan and establishing a very specific investment mix, timeline mix, security mix, right for your particular circumstances. Now, I think is really important we talk about psychological blind spots. I'm just going to cover some of these, but what happens for many retirement investors, it's actually the psychology of investing and the emotion of investing that can derail them and hurt them financially in their retirement years. And it could have an impact in terms of what level of income they can sustain. So this is a really important area. So being self-aware enough that you understand which of these subconscious issues or psychological blind spots may affect you is a really important part of your retirement investing strategy. Now, this is going to sound a little bit like self-promotion when I say this, but I would say that one of the most important things that an advisor, and if you're working with an advisor, hopefully they're playing this role, is to help identify and make you accountable to some of your blind spots. So when the advisor sees you doing things that are not in your best interest because you're being motivated subconsciously in directions that you're not even maybe aware of, they can maybe stop in that moment and provide some accountability or encouragement so you're making the right decisions. So we've all heard many of these. I've covered some of these in past videos, but you've got herd following and following the lemmings, tribalism, recency, which is a really big one. If you've had some great performance in your portfolio the last few years, many investors have, it creates sometimes a false sense of security or expertise, maybe a lack of humility sometimes in terms of how much they actually know. So investment markets are pretty efficient. And when somebody experiences overperformance, they may sometimes attribute it to their wisdom or knowledge, and it may in fact be more to do with just timing, a little bit of luck, more than anything else. So it's really important that we cultivate a little bit of humility when it comes to investing. And if we don't, sometimes it can lead us to make decisions that could really hurt us. If you look at lack of objectivity, that's a super key one. We work very, very hard for our money, and what happens is when the markets begin experiencing some volatility or there's economic challenges or geopolitical events, we can do all the homework in the world and have a great plan, but people will torpedo those plans if they're not being objective about next steps when there are time of uncertainty. And there's no doubt that we will always hit times of uncertainty and market volatility and geopolitical risk. And you need to think through properly in those moments what the right steps are from an investment standpoint. And then all of us can have blind spots. And again, I think advisors play a really key role in that particular area. So psychological blind spots, I may be preaching to the converted here with some of you, but this is a really important area. It's not about the best ETF structure or portfolio mix or that kind of thing. This is the stuff that really can hurt people over time. Now, I'm going to show you a couple of snap projections. So in the modeling, we're going to look at a low-risk portfolio model. So the client we're going to take a look at is inherently conservative, does not want to take on more risk than is necessary, and I'll cover off the details in a minute. And based on the results of that first model, he wasn't too happy with the results, and so he was open to the idea of adding some risk assets to his portfolio. So we revised the asset mix and ran the numbers and demonstrated what the potential ripple effect would be for him. Now, the main value of going through that exercise is that his default is low risk. And the only reason he would deviate from that is because he believes that he doesn't want to change his goals from a cash flow standpoint and is open to the idea of fine-tuning through both modeling and financial education, the idea of revising his approach to the portfolio. So that's what we're going to take a look at together. Okay, I'm going to introduce you to Tom Cycle. He's got a great last name. I love cycling, and the fact that he's got a last name Cycle is pretty awesome. So let's take a look at the main factors here for Tom. Tom's birth date, 65. We're going to use 2025 is the start date for his retirement, and Tom lives in Ontario, so we're going to apply Ontario tax rates. His goal is $60,000 per year of after-tax income, basically $5,000 a month net of tax. And again, when I go through these scenarios, I mean, this is just an example of the iterations we can do. Obviously, your situation is going to be different from this, but hopefully it gives you, a good idea as to how this modeling can work. So for Tom's financial assets, we have him with an RSP account of $400,000, a TFSA worth $120,000, and a non-registered open account worth $500,000. Tom wants to be very cautious with his portfolio, wants to sleep at night. He's just going to buy GICs, and he's hoping to get 1% above inflation. We use 3% inflation rate in this model, so the $60,000 of after-tax expenses that he wants to build into his budget will be indexed at 3%. And we assume that he'd get 4% on the portfolio. So he'll squeeze the rate, he'll rate shop, he'll do everything he can to get 1% better than the inflation rate. So the portfolio makes 4, inflation is 3, he nets 1, pretty conservative assumptions. Of course, his non-registered portfolio, all GICs will be generating full interest income, which is not very tax effective, but he'll sleep at night. His condo is worth $500,000, and the cost base on the condo is $250,000. So let's leave that, and what I'd like to do now is go to the government benefits. Tom has decided to defer taking Canada Pension Plan to age 70. He's at 80% of the CPP maximum based on his career pensionable earnings. His age 70 CPP benefits are projected to be $21,795. He's decided to take his old age security benefits to 65. He's not convinced that it won't be impacted a little bit by changes that the government might make to clawback ceilings and things. So he's more concerned about that. He'll take it when it's available to him at age 65 and then defer CPP to age 70. Okay, let's look at the SNAP forecast. Again, there's a $60,000 per year of after-tax income, index at 3%. It goes from $60,000 after tax by Tom's age, let's say 75. That's now up to $93,478 in after-tax expenses as an example. So that expense needs going up every single year. If we go across, you can see the drawdown from his portfolio. So the drawdown order we used, particularly for this forecast, was registered or RIF assets first, then non-registered, then tax-free savings account if required. And what that meant was there was money coming out of the RSP so that by his going into his age 64th year, he'd fully used all the RSP RIF capital. And then going into his age 65, 66, he's beginning to go into his open account. So we go through the RIF account here. Now we're going into the open account every single year. And then by his age 79, he's now going into his TFSA account. And that TFSA account is now fully depleted going into his 83rd year. The red here is shortfalls in the analysis. Now, one of the things you'll see here, and this is really the power of the iterations, and we can iterate this thing like crazy looking at different scenarios. One of the things you see here is that the TFSAs along this period are not being funded. So what we could do is move money from his open account each year prior to its need to generate cash flow into TFSAs, so he's getting the benefit of that tax-free compounding. So we didn't do that in this analysis. That'd be something that we could take a look at. Now let's look at the charts from a high-level standpoint. So the purple, again, is the cash flow needs, $60,000 index at 3, and you can see that he's beginning to run those shortfalls going into the 83rd, 84th year. Now, practically, visually, the green here, that's the RIF payments from the portfolio fully depleted by his 64th year. We then see his open account that begins generating income in his a little bit in 64th year, fully depleted by his age 78 right here. We then see the TFSA being utilized in the last few years of the retirement projections. It's fully depleted by his 83rd year. And then we've got the old age security here in dark blue, and then the Canada Pension Plan in the lighter color blue. Now, what happens to the net worth position? So what you see here is the blue is his real estate. It's never used in the analysis for cash flow. Here's the portfolio value. So the light blue, TFSA, and green, non-registered portfolio. So it's fully going down. We're killing the goose that lays the golden egg. So that by his age 82, it's fully depleted. He's concerned, longevity's in the family. What if he kept spending at that rate? Well, he'd go into home equity. So we do a rolling balance. He would have used $551,000 of his home equity. The value of the house at that point, age 90, is $793,000 in the forecast. So he still has some balance sheet assets remaining in his 90th year, but he doesn't really like the look of that. So initially, he said to us, I want to be conservative so I can sleep at night. And when we talked about this analysis, he said to us that at the end of the day, $5,000 a month net is not a number I really want to move away from. I kind of need that to do the things I would like to do. I really dislike what I'm doing at work. I want to retire in 2025. So I'm willing to look at some alternative strategies for the portfolio and to see what the ripple effect is. Now, it doesn't mean for sure that he's going to make those changes, but that's the beginning of this educational process. It's marrying the goals of the plan and looking at the ripple effect, and then incrementally, introducing ideas that might move Tom closer to his long-term cash flow goals. So let's look at a different scenario, feathering in risk assets into the portfolio. And when I say risk assets, we're still talking high-quality growth investments. The big banks, insurance companies, energy companies, market-dominant companies that pay great dividends, strong balance sheets, and make money over time. So we're not talking high-risk investments. When I talk about feathering in risk, that's what I'm talking about. Okay, let's take a look at the alternative strategy. Okay, in this second snap forecast, we didn't change any of the assumptions from the previous forecast, with the exception of the assumptions around return and asset mix for the portfolio. So let's go into Tom's portfolio mix and take a look at those specific changes that we made. So what you can see here is on his portfolio, we have a blended portfolio strategy. Now this gets back to this idea of timeline investing, which I'm going to cover for you in a few minutes. So we're going to connect the dots between the strategy that's going to make the plan work for Tom and then how it intersects with the specific portfolio strategy. We'll go from the plan to the investments. So the RSP account, as you already know, we're going to put more pressure on the RSP in the early years. And so we're using 70% cash or cash equivalents. That would be GICs or high yield savings accounts. We're going to use 10% in short duration bond portfolio, and we're going to use 20% in an equity portfolio. So we're going to assume that the GIC portfolio is actually a lower return than we used in the other analysis, 3% for cash and GICs, and that's 70% of the portfolio, 3.9% for an aggregate bond portfolio, and then 20% high-quality equities using 7% returns long-term. So that's a weighted average return for the portfolio of 3.89%. So it's overweight GICs and high-yield savings. If we look at the TFSA account, in our model, Tom will not be using that account for years. So we used allocation of 20% fixed incomes. There's still some bonds in the portfolio earning 3.9% on average, 80% of the portfolio in high-quality equities compounding at 7% long-term over time. And that portfolio mix is projected to generate a nominal return of 6.38%. So, obviously, 3 percentage points higher than the RIF account or RSP account. And then the open account is a mix, $500,000. We're using a cost base of $300,000, so $200,000 of unrealized capital gains in that portfolio. So when we do sell off assets, we'll trigger capital gains. If you look at the mix, we're using a 10% cash position at 3%. We're using a 30% fixed income position at 3.9%. And we're using a 60% stock or growth position at 60% of the portfolio with a weighted average return on the portfolio of 5.67%. Now, with this open account, rather than generating 100% interest income, this portfolio will generate some interest income from the cash and the bonds, but the 60% that's invested in stocks will generate dividend income, price appreciation, and some realized gains when there's fine-tuning to the portfolio. We assume a 5% turnover rate on the portfolio for repositioning assets. And then if assets have to be sold, in addition to that, to provide liquidity or income, that'll trigger capital gain as well. Okay, so overall, I'll talk about the investment mix we put in place. for Tom in just a minute, but what I want to do is show you the ripple effect in this particular analysis from the other base case that we reviewed together. Okay, this is the master spreadsheet. You can see with the RIF accounts or RSP accounts, we're getting a weighted average return of 3.89% on the portfolio. You can see on the TFSA account, we're getting 6.38% on the portfolio. And then you can see on the open account, we're getting 5.67% on the portfolio. Now, I did make an adjustment, and this is where you're getting into the details and the further iterations. We went through the RIF account, we're going through the non-registered account, and then later on when we start going through the TFSA account, I did make an adjustment to the return because we're going to change the mix over time. So my portfolio recommendations you'll see in a minute around timeline investing are tied to where the portfolio is at right now. So one of the most important things around retirement income planning is updating the forecast and updating the portfolio strategy on a regular basis. What I did here is I went in at Tom's age 82 and I adjusted the asset mix to become more conservative. So you can see that the weighted average return went from 6.38% to 4.88%. And then we continue to draw money from the tax-free savings account. So if you look visually at what happens for Tom, the first thing you'll notice right away is there's no deficits. He fully funded his long-term retirement, $60,000 per year after tax, index at 3%. So he's very happy with that result. The next thing you'll see is, of course, the RIF account was fully depleted, early, age 64. Then the non-registered account had a longer life expectancy. It's depleted by age 82. And then the TFSA account's used, and it is used until the 90th year, which is the analysis. And then you've got the government benefits kicking at the bottom here. So we've extended the life expectancy of the portfolio through those asset mix changes. So it's a combination of more tax-effective investing on the non-registered portfolio and an overall nominal return that was a little bit better. Here's the asset mix or the net worth statements. You can see that the financial assets in blue, RIF, green, TFSA, non-registered account, those assets slowly go down so that by his age, Tom's age 90, he's pretty much fully depleted all financial assets. But the big difference is he never had to go into home equity to fund his lifestyle. All that equity is still protected. So if he continues to live past that point, that's less of a concern for him, although there's longevity in his family. He felt that if he could protect the equity in his home, then he felt okay spending at this rate. And he's been convinced through these discussions and some financial education that he will likely go with this strategy. So on that basis, what we decided to do is to develop a specific allocation for his portfolio and then tie it to timeline investing. So let's take a look at that. Now let's just talk a little bit about the timeline, then we'll look at the snap forecast and, like I said, connect the dots. So it's a very simple approach. We've got a timeline over the life expectancy of Tom. So in this timeline here, this is for money that's going to be required from the portfolio over the next 3 years. And that money needs to be very conservatively invested because we can't take a risk of market volatility, and we never want to sell these assets at a loss. They need to be guaranteed, very riskless assets. And the kinds of investments typically you'd look at in this category would be high yield savings accounts, government T-bills, GICs, and short-term government bonds potentially. The bond side you need to be a little more careful about, a little more nuanced, but these will be the main categories. Bottom line, you want to be very cautious. Now, that will put a drag on the overall portfolio returns, and that's why you need to do the forecasting so you know how much you need to fund your goals, but you don't want to be overly conservative because you'll obviously put a drag on the portfolio performance. The next category is a timeline of, generally 4 to 7, 4 to 8 years. And this category is, it's not short term, but certainly if you experience market volatility on an asset that might be needed in the next 4 to 5 years, depending on how much volatility it is, it may take 4 to 5 years to come back to its original cost base. So you want to be cautious with this. You can take more financial risk in this category than this short-term category, but you need to be very careful. And you want to try to boost returns a little bit. So you can use balanced ETFs, balanced mutual funds, preferred shares, active allocation, income vehicles. So there's a range of investment products. The purpose of this video is not to give you specific recommendations. It's more about the architecture around designing a portfolio. So the investments that you use, you go to your advisor, your financial planner, your investment broker, your portfolio manager, or do it yourself through Quest Trade if that's something that you like to do. And then the last timeline 3, is usually 8+ years. This is long-term investing. This is basically being fully equity generally, high quality common shares or stock, ETFs as an example, and you're just trying to grow the market. There is an argument out there for many investors where they would rather look at a barbelling approach, where you have cash on one side, GICs and high yield savings, and just growth on the other side. And I think at a theoretical level and a real world level, that probably is the best approach to use from a total return standpoint. But my experience, again, going back real world testing, is that's not most investors. I find that even sophisticated investors that are knowledgeable, when you see excessive market volatility, even those people tend to bail sometimes, or at least are inclined to bail sometimes, based on their wisdom and research and intellectual understanding, because the emotional and psychological piece starts to overwhelm them. So that's why we feather in these 3 timelines. So rather than being all equity on one end of the barbell and all cash on the other end, which theoretically is a better approach from a total return standpoint, we think it's more prudent in real world, in terms of how most people react and respond, to have these 3 different categories. So with that in mind, let's just take a look at Tom's particular portfolio. Again, one more comment. We talk about this wedge strategy. You look at the overall portfolio. At the short end, you take a piece of the portfolio and you build in your income payments in guaranteed investments in the portfolio. So here is a section from the SNAP report, which I did not show you in the previous section, but one of the printouts takes a look at financial inflows and outflows. And you can see the outflows from the RIF account each year, and then the outflows from the non-registered account once the RIF has been fully depleted. And so we use those numbers to get an idea of how much money needs to be in each major category on the timeline. So you do the forecast, you do the iterations, you find out what the drawdown is between the various accounts, and then you use these dollar amounts to feather in the appropriate allocations by timeline. You want to do sufficient for this timeline, the lower risk category, but not too much, because you don't want it to be too much of a drag on the portfolio performance. So when we applied the approach, the timeline allocation for the short-term amounts for his portfolio, money required up to 3 to 4 years. We use 4 years in this example. Tom needed to allocate $254,305, or 25% of his total portfolio, was just over $1 million, to this particular timeline. It would be divided up between high yield savings and GICs. So $127,152, or 50% of this $254, would be to cash and GICs, and then the remaining 50% would be allocated to a short duration bond portfolio. So there's lots of different investment options to choose from to build and construct this portfolio. I know when we work with our clients, because we're an IROC investment brokerage platform, we can shop the market to get the ideal securities to build this particular component. Now, the timeline allocation midterm 4 to 8 years, the total allocation on just over $1 million would be $347,836, or 34% of the total portfolio. We'd use balanced mandates, roughly 40% fixed income, 60% stocks. That means the bond position would be $139,134. The stock position would be $208,702. Okay, so we start with a short-term timeline. This is the midterm timeline. And then we get into the long-term timeline in a moment. I just want to show you a slide that talks about the middle-term timeline. And I think this is a great illustration around the importance of diversification. So this particular table looks at returns by asset class from 2000 through to 2001. And it's looking at Canadian large cap stocks, Canadian equity, small cap stocks, U.S. equity investments, international equity, global real estate, emerging markets, Canadian fixed income, global fixed income, and high yield fixed income. And the last category is what we refer to as a balanced portfolio. Now you can see that in any given year, there's quite a bit of volatility and fluctuation in all these different asset classes. It's obvious it's very difficult to predict which of the asset classes are going to give us the best performance or the worst performance in any given year. It's a very difficult thing to predict. Now, if you're focused out 8+ years, you're not going to be too concerned about that. You're going to go with growth, high quality growth investments, and you're not going to worry about the short-term fluctuation. But in the middle term timeline of 4 to 8 years, that's a good amount of time, but it's not a long time horizon in the scope of overall investing, particularly if you see a lot of volatility. So you can see that in good markets or bad, the balanced portfolio, which is 40% fixed income investments, 60% equity or growth investments, yeah, it fluctuated, it had some volatility, but it sort of skirted along the middle of these extremes all the way through these years. What you're trying to do is to manage good income distributions and lower volatility, but still getting a total return experience that is competitive in the overall scheme of the retirement income plan. So at the end of that time period, from 2000 to 2021, the long-term compounded net of cost returns on that portfolio were 9.1% per year. That was the fourth best long-term compounded return of all the different asset classes. So the balanced portfolio did pretty well relative to the others. And then you can see that from a risk standpoint, as measured by standard deviation or swing rate, it had the third lowest level of risk compared to all the major asset classes used to build portfolios. So when you look at that middle term category, you want to focus on solutions that kind of make sure that they're managing the portfolio so that you don't get those extremes. You're not going to get the most amount of return, and you're not going to get hit the barn doors out, blow out the returns. What you want is consistency of return and less volatility in the portfolio. Now, the last timeline, of course, is long-term, 8+ years. Out of the whole portfolio, just over $1 million, we've got $417,859, or 41% of the total portfolio allocated to this category. 100% should be invested in securities tied to the stock market to maximize the long-term growth. So when we've done all that, what does that look like from an overall asset mix standpoint? So what you can see is that GICs, high yield savings accounts, would be 12% of the overall portfolio. The overall mix that Tom has is $1,020,000. Short duration bonds, which are very conservative, although you have to be a little bit tactical when you put them in the portfolio, 127,152, another 12%. You've got the aggregate bond portfolio positions, 139, 134, or 14% of the overall portfolio. And then stocks would be 626,000 in total between the balanced positions and the pure growth positions, or 62% of the overall mix. So when we did this snap debt entry, we tried to stay pretty consistent with that, but we had to mix the investments based on investment category and which bucket was paying out at what time. But generally speaking, this mix originally, you're looking at about 12% cash, 26% fixed income, stocks and growth about 62%. So when we go through the exercise of SNAP, timeline allocation, and then building the portfolio, this is where we're beginning to pull the pieces together to put together one coherent game plan. But what you can see here is that we actually have 3 different portfolios in each of the 3 different timelines, and then we have an aggregate asset mix. So again, to illustrate that, when we go back to the SNAP forecast, you would have remembered that on the short end here, the cash position, we were putting a lot of pressure on the RIF account. So it was fully depleted in the first few years of retirement. So most of the RIF account allocation was towards GICs and high yield cash accounts. You then saw in the SNAP forecast, we began to put pressure on the non-registered account. So that portfolio was not as conservative as this portfolio, but in the overall game plan, it was still pretty conservative. It had a fair amount of fixed income and had some cash equivalents. And then in the final allocation for the original mix that was put in place, we had 100% equities in the asset mix in SNAP for the tax-free savings account, because that account was the last account to be utilized. We had a long time horizon from an investment standpoint. So in the final analysis, that's how you connect the SNAP forecasting and the asset mix modeling to timeline investing. And then the last piece is to meet with your advisor, or if you're a do-it-yourself or you do it on your own, you begin sliding in investments that are appropriate for each of the major timelines. Now, one of the key steps in getting ready for retirement and building your retirement portfolio and managing your investments in retirement is managing your balance sheet. Be very tactical around the assets that you have in your net worth statement. So, of course, Tom has just over $1 million in financial assets. He has $500,000 in real estate. And before Tom retires, it's really important that he approach his bank or credit union and get the largest secured line of credit he can get. Now, why would he want to do that? There are a number of different reasons. And by having this line of credit, Tom can be tactical based on circumstances that come up for him. So you want to look at your investment strategy as a balance sheet decision, not just an investment security decision. So Tom might be in retirement, and all of a sudden some lump sum expenses come up, And let's say based on other income he's already taken, he doesn't want to trigger some capital gains on his open portfolio or take out more money from his non-registered accounts, and he really wants to leave his TFSA alone. Well, he might use over the short term his line of credit to fund that expense, and then over time pay back that line of credit. Of course, the loan amount's not taxable income to him, so it doesn't cause him any tax grief, other than he just has to service the interest costs, so there'll be some additional expenses for that. But it could be a really good way of navigating those balloon payments or expenses that come up out of the blue that you have to fund. The other reason is sometimes, obviously, there's outlier negative returns in the markets from time to time, so unusual return experiences on the downside. And what can happen is you're going through your risk-free assets to produce income or liquidity, and maybe you're getting to the point where you're almost through all those risk-free assets, and your midterm portfolio strategy got hurt a little bit in the market volatility, and you want to give it a little bit more runway to recover. And if that's the case, you could use your line of credit short term to fund some of your expenses, allow the middle term portfolio to bounce back, and then you can use assets from that portfolio to pay off the line of credit. And so the line of credit allows you to be tactical, and that's one of the steps in the investment strategy planning for retirement, is look at it as a balance sheet item. Now let's go back to the 7 steps sheet and take a look at each of the items we've covered. Well, of course, we've covered most of these steps in this discussion. What kind of investor are you? Do you have a plan? We've talked about the SNAP forecasts in that area. We've covered off in detail timeline investment strategy, managing your balance sheet, and ultimately your timeline and SNAP projection will help you define which mix of investment securities that you'll use for your portfolio. Your asset mix gets driven by your timeline and your plan. On the security side, of course, you've got all kinds of options out there through your advisor, your investment broker, your financial planner, or maybe you're a do-it-yourself investor. Don't hesitate to reach out to our office if you'd like to engage in a discussion on this kind of planning. And then one of the things we do is we provide security recommendations to help people implement on the recommendations. And then the last step here is ongoing maintenance, and that's really critical. This is not a one-and-done process, and that's where people make mistakes. They go through the exercise of building a plan, everything's in place, they put a lot of time into it, or they worked with their advisor to do it, and then for whatever reason it was not reviewed, it was not updated. Little things like profit taking along the way, rebalancing the strategy, revisiting the timelines. It's really critical that you do that. Pre-retirement, you're just allowing your portfolio to compound and grow. You're not overly worried about going in and snipping profits necessarily. You view that being fully invested is maybe the best strategy. But when you're in retirement, it's critical that you go in from time to time to do the profit clipping, protecting those profits and putting that into safe harbor or more riskless assets that will eventually be in place to provide income and liquidity for you. So these are the 7 key steps. Make sure you're utilizing those steps to build your own retirement income portfolio. Hope you found the video helpful. Again, if you are getting close to retirement, maybe you already retired, and you'd like to get a second opinion about your planning, there's a link back to our website. On the homepage, we talk about our complimentary gap analysis. If you'd like to get a second opinion, make sure you go to the homepage. You can reach out to us on the homepage to set up a complimentary meeting to discuss our process and how our services work. As well, if you haven't subscribed to our channel, make sure you do that so you don't miss future content that we're posting on a regular basis. You take care. All the best in your retirement and overall wealth planning.